Larry Shover is joining us to talk some bonds. He's a managing director of Exchange Capital Resources. Larry, so treasuries were bid pretty much throughout this week, with the exception of some response to the Moderna news. But overall, we've been buying up bonds again in the market since Pfizer's caused the spike. So what are we to make of this, Larry? Is that just still kind of the path of least resistance? Are we still in an uptrend for yields overall? Walk me through it.
Well, given the fact that we opened the week around 90 basis points, closed the week, about 83.5 basis points, it's still encouraging, but I think there's more behind the scenes with regards to, the pandemic news and the trajectory and the inference to the economy. That is of key importance, but really the politics surrounding the emergency liquidity measures seem to be undermining the market, or at least consensus, as it were. And I think that's why we saw a bid going into the close with the 10-year Treasury.
So, Larry, right now we've gotten this kind of short-term reversion of the yields back down. But when I look at that 3-month kind of channel to the upside, it doesn't look too impressive, I got to say. I mean, this is a pretty good Treasury rally. We've gotten down from 9.6 to 8.3. It's a solid little move, right? But the fact that we've been doing this for 3 months, it doesn't even look like we've hit the lower bound of the range I've got on this thing.
No, I don't think so. I mean, there's so many moving pieces in place, and again, the politics surrounding the emergency extension of liquidity programs is definitely the eyebrow raiser right now, which is causing market fluctuations. But we definitely have plateaued for a while at the high end of the range. I mean, especially when you consider where the 10-year was back in the summer. We went up to 1% as stocks were at all-time highs. That was comforting as well, because the last time we saw that in December 2018, we all remember what happened. So it's going to be really interesting to see what happens, and perhaps we'll have an answer before the December 16th FOMC meeting.
Larry, last we talked was pre-vaccine. I know you're looking generally for the kind of trend to continue with yields pushing slowly higher. Correct me if I'm wrong. I believe that's the last conversation we had. What do you make of the way we've responded to this big deal that we are going to have a vaccine sometime next year?
Yeah, no, and I still think yields are going to creep higher, and we will see 1%, maybe a little bit higher by the end of the year. But that said, we backed off with yields a little bit this week, even though we've had tremendously affirming vaccine news. But I think there's something bigger, perhaps not bigger, but something overarching at play, and that is what is going to happen when these liquidity programs run out. And I think what we're seeing in the longer date yields, and we're seeing a little bit more of a flattening of a curve, is that there's this prerogative that the Fed's going to be forced to be buying longer-term dated yields by adjusting the WAM, or the weighted adjusted maturities in the market. And so I think that's what's going on. Not sure, but it seems to be, it makes a lot of sense.
Okay. So, Larry, right now, the short term, we still see the big moves higher in yield are going to have that inevitable kind of drop back. In terms of the policy standpoint, what role do you see that as playing? We had a little bit of a dust up between Powell and Mnuchin. I don't know how much of it is drama, how much is going to be real or meaningful, or if it's just shifting money to get spent on Americans from one category to the other. I don't really know. What do you think, Larry?
Yeah, well, I have to say I'm sympathetic to both point of views, because both of them cost money and both of them have implications to our capital markets. But, I think, the market is the great equalizer, and with treasuries, resting, as it were, where they are right now, suggests the fact that it's a little bit unclear, but there might be a temporary extension. But it perhaps will prompt the Fed to have to buy more longer date maturities, and that's something why we're seeing the longer end of the curve kind of drop a little bit yield wise, as opposed to what should be happening with the reignition of reflationary ambitions, as it were.
Hey, do you think we need a big fiscal deal, by the inauguration for bond yields to keep climbing, or they've just picked their direction?
No, I don't think necessarily so. I mean, I think if this gets ironed out before the meeting on December 16th, we definitely can continue to climb a little bit higher yield-wise. I mean, I don't think it necessarily have to have some splashy fiscal deal, although obviously that would be nice. But I think it's more about just figuring out what's more important, grants and bailouts, or keeping the existing bailout liquidity functions in place.
Okay. Larry, always a good conversation here, useful in thinking about the Treasury market. Thank you, Mr. Shover, Managing Director. Thank you, sir, at Exchange Capital Resources.